Welcome everybody to this Hardman Investor Forum. My name is Keith Hiscock and I'm the Chief Executive of Hardman Co. These forums give investors the chance to hear a company's or a fund's investment case and question the management. The first one comes from ICG Enterprise Trust. This trust provides investors with a chance to invest in private equity through a public vehicle traded on the stock market. In the past, only big institutions and family offices really had access to this pool of assets. ICGT gives ordinary investors, every sort of investor, the chance to access this pool of investors and the pool of assets, and it brings liquidity to a space that's naturally rather illiquid. You'll see on the screen a quick summary of the shareholders. So the biggest shareholder is Bank of Montreal, 870 million market cap, a decent yield. The chart you see in front of you shows the discount to the NAV. You'll see that the line running through shows that we're trading a greater than 20% discount to NAV at the moment. So not only does this give you access to an interesting set of assets, it's quite otherwise difficult to get access to. You can do so at a discount to NAV. Now, we're very lucky today to have two speakers from ICG Enterprise. Oliver Gardy, who's the head of private equity fund investments, and Colin Walsh, who's managing director. Gentlemen, over to you.
Thanks for the great introduction. I just wanted to say thanks for everybody. It's a great pleasure that you are attending the conference, and it's a great pleasure to be invited to the conference. Keith has already done a great job introducing us, and our mission is really, and that's why the title you see here is what ICG Enterprise Trust is all about, is democratizing private equity. 20, 30 years ago, private equity was just a niche asset class, which only a very few privileged investors, such as ultra high net worth families, sovereign wealth funds, or large pension funds had access to. Today, this little niche investment strategy has grown to an established asset class with exposure to all sectors within the economy. As a matter of fact, in the UK today, there are about twice as many companies owned by private equity funds than the amount of companies listed on the UK stock exchange. However, there is a big issue getting good access to private equity investments, which has been notoriously difficult for small institutional and retail shareholders. And we'll talk about how do we structure and how we design to kind of get around those issues. And as I said before, our mission is to democratize private equity. So everything we have done here with the private equity trust in terms of investment strategy, as well as the structure, it's all dedicated and designed for retail investors as well as small institutional shareholders to have access to private equity without the issues private equity has in terms of, for example, liquidity and some of the risk behind it. And I hope after this presentation, you will understand what we've done to make private equity attractive for retail shareholders. And effectively, what we're doing is we're providing our shareholders with the greatest hits of private equity, or the best of private equity. With that, I would like to go straight into the first slide. Many of you probably have seen that private equity has outperformed over long term all other asset classes. Not has it just outperformed, it's outperformed it significantly across all other asset classes. The industry today is 6 trillion assets globally, so it's getting to quite a important size. Still significantly small enough to provide good returns and alpha compared to other assets in the investment world. The challenge for private equity, however, is that you need to get really selection, and access really matters. As you see here in private equity, there is a large dispersion, and it's probably the largest dispersion of any other asset class between the top quartile performing managers and the bottom quartile performing managers. Or phrased differently, if you're getting access and you can select the top performing managers, you're getting great returns in 15 to 20% IRR. And that is really important because that's obviously for small institutional shareholders and retail shareholders. A, even if you can select and you know which managers you should be invested in, getting access is very difficult because those managers are typically oversubscribed, and the minimum ticket to participate is somewhere around 10 to 15 million. ICG, and we'll talk about it, how we get access to it. But our being 40 years in this industry, we obviously know all the managers. We are part of the community. We're part of the fabric, and we have the selection tools and the analysis and the team to get our investors access to the top quartile managers. Moving on to the next slide. Why is private equity outperforming all other asset classes? It's pretty simple. It's actually the active ownership model really drives the outperformance. It's being able to actively drive strategic change, operational improvements, and also installing financial discipline through internal house capital markets expertise, and providing not just capital markets, but also sector expertise, certain management expertise, and follow-on capital really allows private equity to buy good companies and make them transform them into better companies. And a lot has to do that with being able to operate and invest patiently. It's long-term capital. Private equity is not bound by quarterly results and need to show their shareholders improvement quarter on quarter. It's really what matters is what you've done over 5 years and how much value have you created over a 4 to 6 year period. Alignment of interest is a key component of outperformance. In private equity, the private equity investors, as well as the management team, are heavily incentivized by the equity, their value they're creating, and usually, and that's heavily skewed towards that. So you become wealthy, or you make a great contribution to compensation is at the point in time when you realize the exits, rather than on unrealized paper profits. So there's a high incentive to actually create exits and proceeds on a realized basis. Why is it difficult for retail investors to invest in private equity? First of all, is what we've talked about is already access. And as I showed you in the previous slide, selection really matters. And therefore, you need to have the team and the resources, as well as the relationships, to kind of get access to those top tier managers. And that's what we can provide for our shareholders, because we've done this business for over 40 years. And you will see in the portfolio and the performance that we have that we can consistently on a sustainable basis provide that. The other challenge for retail investors is it needs a lot of capital to kind of build a diversified portfolio, because typically the top tier managers, they can dictate who they would like to have as an investor. And typically they don't pick up tickets lower than 10 to 20 million pounds. So it takes, in order for a retail investor to get a good diversified portfolio, or any investor get a good diversified private equity portfolio, you're talking about hundreds of millions of pounds you need to have, which is obviously very difficult for a retail investor. So we can break that down, because we can provide that we can provide those type of investments to our managers. A key point is liquidity. It takes a long time in private equity till the capital is invested and until it's realized. So typically it takes about 7 to 8 years until the complete circle has come around, where you have invested in the fund and invested in the investments, and until they have been realized. So from the realized proceeds, you can then start reinvesting again in private equity. Versus what the Enterprise Trust does for you, the retail investors, is it has already a ready-made portfolio which is in full cycle. So it constantly makes new investments as well as gets realizations and distributions. So the portfolio is already fully put together. And lastly, and very importantly, obviously, the liquidity of the share is entirely unconnected from the liquidity of underlying portfolio. So anyone can buy today a share of Enterprise Trust and sell it in the afternoon or a couple of days later, or whenever the individual would like to sell their shares in ICG Enterprise Trust. So it provides daily liquidity. And then lastly, investing in private equity is loaded with a lot of administrative burden, KYCs, and so forth. We all do this with our team for our shareholders, so we do not have to. We're not. Our retail shareholders don't have to bother with that. It's a very easy purchase, just purchasing a share on the stock market. I won't spend too much time here because we'll use that as a summary. But I think what we would like to give you here comfort is that we have a lot of experience. We've been doing this for 40 years, and we're a long-term investor. We have a very clear purpose, which is all about, and everything is designed to really democratize private equity and to give our investors the greatest hits of private equity. And we're benefiting from a unique access of the ICG platform, which is one of the largest private markets investor in Europe. And so we have a lot of insight into the private equity managers, into the portfolios, which helps us in picking the right investments and the right funds. And that all, having those components work together really generates consistently strong returns. So we've had 12 consecutive years of double-digit portfolio growth, and we are expecting a 13th. 2021 looks very strong, and we're expecting a 13 consecutive years of double-digit portfolio growth. Now we should talk about, on the next slide, about our strategy and how it's specifically designed and structured for small institutional and retail shareholders. So private equity has a great returns, and as we said before, it outperforms any other asset class. But it does have that inherent risk and illiquidity, so one has to be careful how you actually invest your capital. And so we are very, very focused on providing our investors private equity type of returns, but with much lower risk and much higher liquidity. And so therefore, we're very focused in our investment strategy to provide the best risk-adjusted returns. And how we generate them, this is a key slide. So when you look at the first four little filters and bars here, those are all created and designed in order to take risk out of private equity. So we invest only in buyouts. Why? Because buyouts have much lower loss ratios than typical venture capital or growth capital, where you're looking at loss ratios of 65 to 70% versus in buyout, it's somewhere around, the top tier funds are somewhere around 10 to 15% loss ratios. We only focused on developed markets because that's where the depth is of assets and capital and liquidity, where you have functioning stock markets, functioning strategic investors who have interest in deals, and that's why you get good liquidity. So only US and Europe buyouts is where we're focused on. And within that buyout sector, we are focusing on the mid to larger deals and the mid-market to large funds, because those are the funds managers where they have the resources. That's where you find they are big enough that they can afford having teams, big teams on their roster who help also not just to buy a business, but then also help in the transformation of the business. So they would have sector experts, they would have experts on purchasing, supply chain experts, as well as capital market experts. So we're looking for teams who are very resourceful, and typically you find them only in mid to larger fund managers. And so that reduces also the risk. Now, the last two filters is really all about how we're driving revenue and how we're driving growth and how we're driving returns. So we're only focusing on top tier managers. I won't repeat why. You've seen the slide, why we're only focusing on them, because they also consistently and sustainable get the best returns. And then we're also focusing on defensive growth. So we're looking for companies who are, and Colin will talk about it in more detail, we're looking for companies specifically who are defensive and resilient during cycles and down cycles, because they have a particular strong reputation, a brand, technology, or processing cost efficiencies, or are cost leaders. And that's so they can weather through cycles, but are in sectors and industry where there's strong growth and continues to be strong growth. And those are the type of businesses we like and sectors we like to invest in. With that, I'm I pass it on to Colm to give a bit more, put the portfolio and the deals and what I've just talked about, our overall investment strategy and approach, to put it to life.
Thanks, Oliver. I'm going to start by taking you through our approach to portfolio construction. And we believe this is a real differentiator compared to our peer listed private equity vehicles. Most of our peers, they're either characterized as being direct investments. They tend to have high single company concentration. They often have a high exposure to a single sector or a single geography. Another peers operate a fund-to-fund strategy. So they've got underlying exposure to literally thousands of companies. And they tend to operate as a kind of an index on the broader private equity industry. We apply both sort of elements of both approaches in our portfolio construction. Firstly, around half of our portfolio is deployed through third-party funds. Now, Oliver's already outlined a very selective approach, and we're focused only on buyouts, only in developed markets, and we only partner with top-tier managers. Whereas many of our peers invest in ancillary strategies, so things like venture capital or growth equity. We strongly believe that mature buyout investments offer the best risk-adjusted returns. And the other half of our portfolio is in what we term high conviction investments. And that's through secondaries, co-investments, and investments alongside ICG, our manager. Now, the unifying theme here is that ICG selects and performs due diligence on the underlying companies. And what this does is it gives us control over the composition of our portfolio, but it also critically enhances returns. And you can see here from this diagram that the high conviction investments have generated returns of 25% in local currency over the last 5 years. It's annualized returns. However, we tend to focus on the blended return, which you can see here, 21%, as these third-party investments are fundamental in order to be able to access co-investments, if you like, as Oliver termed it, the greatest hits, alongside the world's leading buyout managers, which shows you our largest exposures. Now, the approach to portfolio construction, which I just outlined, means that our top 10 companies are a little under 30% of our portfolio. And that means that their performance makes a meaningful impact on our NAV growth, but without taking excessive single company risk. Now, we'll be very happy to take questions on any of these companies, or indeed any of the other companies in our portfolio afterwards. But I'd just like to draw out a few themes. As Oliver outlined earlier, we're very focused on the concept of defensive growth. So identifying companies which have underlying growth drivers which outweigh any cyclical fluctuations. And in each case here, each of these companies, there's a very strong secular trend or trends which underlie each investment thesis. Another feature of our portfolio is the involvement of ICG. So 4 out of our top 10 companies are managed by ICG. And our larger exposures come from ICG's Europe strategy. Now, interestingly, that's been a cornerstone of our portfolio for most of our 40-year history. So our first investment in an ICG Europe fund happened way before we were managed by ICG back in 1989. Since 2016, when we joined ICG, we've been, being part of the platform has given us access to very strong deal flow, and it's very aligned with our defensive growth focus. One thing which is worth pointing out is that many of the companies in our portfolio have actually found, it's been obviously a relatively challenging environment, but many of our companies have found recent market conditions actually very favorable. For example, cloud software businesses like Visma, our 4th largest investment, saw growth actually accelerate through the pandemic as companies adapted to remote working. Leaf Home Solutions, US-based home improvements company, benefited from a significant increase in demand for home improvement services. For the very obvious reason that most people were spending more time in their homes. And Berlin Packaging, a company which focuses on the design and supply of packaging primarily for end markets in food and healthcare, benefited from strong underlying growth in those end markets as consumption patterns shifted away from restaurants and more towards consumption of food and healthcare products at home. One of the aims of our defensive growth focus is a desire, and you see this in the underlying performance of these companies, is a desire to achieve consistent returns. And we're just going to spend a little bit of time over the next few slides showing how that's reflected in our performance data. And you can see here on slide 11, our portfolio returns over the last 12 years. And you can see a very consistent track record of double-digit growth on a local currency basis. Since we joined ICG, and the first ICG year is FY17, we've generated annual portfolio growth of at least 15%. And in the last full financial year, despite the impact of the COVID pandemic, the portfolio had one of its strongest ever years, with 25% growth, which we think is a real testament to the strength and resilience of our strategy. I think here the main thing is just to pick up on the consistency I was outlining. You can see here there have only been 2 quarters over the last 5 years where we've had contractions, and one of them was during the COVID pandemic. I think this reiterates that sort of the very consistent, steady returns we've been generating. Very briefly too on the dividend, you can see that since we adopted a progressive dividend policy moving to ICG, the dividend has steadily increased, and the board is aiming to pay a full year dividend of 27 pence per share, assuming there aren't any unforeseen circumstances for the current financial year. And that's a significant increase over last year's level of 24 pence. Just to touch on this very briefly, it's a recurring trend in our portfolio. And you should probably think of this whilst you're thinking about the underlying discounts as well. There's a long, sustained track record of realizations being at a significant uplift to carrying value. You can see those numbers on the chart. And we think that represents substantial hidden value within the portfolio, particularly given the consistency of that pattern. And very briefly, I suppose the key messages we'd like you to take away, and apologies if there's a little bit of repetition, we're a very experienced, long-term oriented investor. We have a proud 40-year heritage, which makes us the oldest listed private equity vehicle in the UK. We have a very clear purpose to democratise private equity, to allow private investors to benefit from the strength of the asset class, and we've got a very strong track record of delivering performance. And finally, one of our core differentiating features is that as part of the ICG platform, we benefit from the resources and experience of ICG plc, a large FTSE 100 company which exclusively focuses on private assets and has just under 70 billion euros of assets under management. And that's been a very significant factor in the progress we've made managing the vehicle over the last 5 years. So apologies for the quick canter towards the end, but I think myself and Oliver will be very happy now to take any questions that you might have.
So there are a number of questions. One of the questions is, obviously what you're doing is investing in a number of companies that have defensive growth strategies, but it can happen that things do not go right. And COVID could be an example of companies that a couple of years ago were priced for success, they're now priced mainly for survival. What strategy or what can you do in those sort of situations to minimize the risk? Because as you say, they're long-term investments and they are illiquid. And there must be an approach that you have when something doesn't go quite right that you can adopt.
Yeah, so our strategy and our investment strategy is very much driven by diversification, making sure that if we do have a problem, it doesn't hurt us. So as you look at the returns, in the darkest hour of COVID, we were only down 4%, which is significantly different to what happened in the public markets. If something does go wrong, we have, because we're long-term investors and private equity has a lot of resources, that's why we invest in funds and management teams who have the resources to kind of really fix the problems. And we have the capital as well as in private equity, you got the capital as well as the time to kind of fix the problems. To give you a sense of where we are in our portfolio. So if you take the top 30 in our portfolio, which represent about 50% of the total portfolio NAV, all of those companies are performing, and we don't have any concern or or a company which is losing its value.
Okay, thank you. What makes secondary transactions attractive, and will there be more of these to come?
Secondaries are incredibly attractive because you're buying effectively a portfolio which is 4 to 5 years, let's say 4 to 6 years in maturity. And when you have those portfolios which are 4 to 6 years in maturity, you can pick the win. You can see the winners and you can see the losers, and the losers typically in that portfolio have been already written down. And so therefore you're getting private equity type of returns because you can price the portfolio yourself, as well as you are getting high diversification. So you're getting much lower risk. Loss ratios in secondaries are typically less than 3%. And you get much higher liquidity because typically in the portfolio, because it's 4 to 6 years old, it's also 4 to 6 years closer to exit and realization. So typically you have on a quarterly basis distributions coming through. So it's a very attractive investment strategy as part of the portfolio. And because we have a large portfolio, we have insight with the managers, we can pick those particularly attractive secondaries. And the future of the secondaries market will continue to grow very much. It's been growing 15 to 20% CAGR over the past 20 years. And it will have another record year in 2021. We're expecting that the overall secondary market will double in the next 4 to 5 years.
Thank you. So we've got a question or a number of questions about the general trends in the PE market and how you handle the changes in valuation, but also how many situations are you looking at any one time that will lead you to a limited number of investments that you actually make, but you must be looking at a very, very large number. How do you filter those down to the manageable shortlist?
Yeah, so it's absolutely true to say that at any given moment in time, we have quite a significant sort of pipeline. But one of the things that I think, given our expertise and market knowledge, is we've adopted quite a rigorous process to filter those opportunities. I suppose thinking about it just in terms of our fund selection, that tends to have less volatility. We're always keeping abreast of we're exclusively investing with experienced managers. So we're tracking managers over time. It takes a long time for a manager to get into our portfolio. So there are sort of fewer surprises there. And that's really an effort of constant market mapping, constantly staying up to date with developments in the funds market. But we typically won't invest with the manager until we've really got to know them. So that's a much more gradual process. When it comes to the direct deals, we're particularly busy.
Just to give you an idea, we're invested about 20 to 30 fund managers out of a total universe in the US and Europe of about 2,500 to 3,000 managers.
Yeah, and we're targeting managers that have, we really value managers that have got strong institutional experience. Actually, that was something we really saw during the COVID pandemic. To answer one of the earlier questions as well, when things were going wrong, actually investing alongside experienced managers has particular value because they know what to do. They've been through crises before. In most cases, most of our managers have managed through the GFC. So they were very experienced at crisis management, and they have the resources to be able to deal with those situations. On the direct side, it's a very busy market at the moment. And just to put into context the kind of filter that we have, over the last year, we've had over 40 what we would consider actionable investment opportunities. And we've executed on 5 of them year to date. So that just gives you a sense of how selective the approach is. How do we do that? We have a sort of a multi-layered filtering system. So at the beginning, we identify if there's any particular attributes of deals that are no-nos for us. So we look at features that increase the risk. Oftentimes it's things that the company itself can do nothing about. So market-driven factors like being price takers, having significant customer concentration. So we have a sort of a rigorous kind of filtering checklist where we try to identify those things early on. And as we proceed through diligence, we get ever more detailed. We conduct a very extensive process. But one of the key features I think that we have that a lot of our peers don't is that we have very strong market intelligence, which comes from ICG. So we have so many other strategies within the group that are often experts in particular industries, and we can tap into that knowledge. And because we're part of ICG, we're getting very candid references and very sort of thorough very detailed access to very proprietary information. So hopefully that gives you a sense of the kind of process we go through.
So the final question is, when you have a successful investment, how do you ensure that basically adequate funding is available to allow that investment to continue to be successful?
Yeah, so the important thing is that you always have significant cash and liquidity available. We have a large facility in place of over £200 million, which and we have about 70 million in cash right now. So we always make sure that we have enough reserves in place, even if we have our full cash and invested. We still have about £200 million we can draw on in terms of reserves. So we have plenty of firepower to kind of make sure that we can follow the growth of winners.
Gentlemen, thank you very, very much.
So that concludes the presentations today. I'd like to thank our speakers and you, the audience, for attending this forum. Thank you very much.